Welcome to the Reimagine podcast. Each week, give yourself 30 minutes and meet the people working hard to create the future of insurance today.
Hi, this is Paul Tyler, and welcome to another episode of the Reimagine podcast. Laura, great to see you again.
Yeah, it's great to be here. It's always an exciting day to have another podcast, and we continuously have amazing guests. So with us today is a familiar face for those of you who have been engaged with our Reimagining Retirement Forum series. Panelists from one of the forums. We have Manish Malhotra, founder and CEO of Income Discovery, with us here today.
Welcome.
Thank you. Thank you, Paul. Thank you, Laura. And great to be here for the second session that we're having.
No, and thank you for giving us as much time as you have in December. Talking and being a very wonderful participant in our Reimagining Retirement series, and we are releasing a white paper from that discussion. And Manish, we certainly benefited from your insight. So, can you tell us? Just tell listeners first and foremost, tell us about Income Discovery, what you do, and the problems that your company is solving.
Great. So Income Discovery is solving the problem broadly of retirement decumulation. And decumulation has not officially entered the dictionary yet, but it would shortly. It's about with the whole transition with people now getting into retirement who don't have a pension. They only have access to Social Security and they've got some savings. So how do they construct their retirement income cash flow? The onus is on them and they are not qualified to do so. And that's what the problem we're working on. And our proposition is to those people working with the industry of financial professionals, enable those professionals to deliver a better outcome in the form of highest after-tax safe retirement income these retirees can have. Increase it by as much as 30%. And we use AI to power those solutions to get the clients $20,000, $30,000 more to live in retirement.
Okay, that sounds good to me, but just maybe explain the problem. Why is decumulation difficult?
It is difficult for multiple reasons. One is if you look at somebody's investment portfolio, they don't know how long they will live. They don't know what kind of returns they can expect from it. And if you really want to spend some money, how do you know how much is safe to spend? You could rather be very, very conservative and not spend anything at all. Live on Social Security, that would be bad, right? You've got some money, you've got to be able to enjoy your retirement. So how do you find what's the right amount to spend? Plus, there are products like annuities, which give lifetime income guarantees, various forms. They are not well understood by individuals, and there are some behavioral biases also in them adopting them. Figuring out what to do with your money, with Social Security, which itself has a lot of options, without getting into the complexity of taxes, because all these things interact with each other. The amount of taxes you pay on Social Security depends upon other sources of income. So all of this is such a complicated mess that it really takes a good amount of solid mathematicians and software guys to really find the best solution for the client, and then tell them simply, this is what you do. And you go and live with $80,000, $100,000, $20,000, $30,000 more than what you would have done otherwise.
So did you always see yourself innovating in the retirement space, or was there a certain instance that took place that really kind of motivated you down this path?
It certainly did, right? I was not aware of the opportunity circa 2008 or 9. While working at Citigroup Smith Barney, when Smith Barney, before Morgan Stanley bought it, before the financial crisis, etc., while I was there, where I got my exposure to wealth management industry, we worked on a retirement income related project internally. And then I was on the IT architecture side of the story. I'm a fintech gentleman, both with an MBA in finance and an engineering degree, and was looking at some fintech opportunities. So after speaking to the gentleman, I asked him, why are we doing this? Why aren't we getting something from the market? And he said, there isn't anything available. So I took it upon myself to research a little bit more about retirement income decumulation from books, papers, looking at the existing software available in the market to come to a judgment that this is really a great need, a big need, and it's a tough problem, and got started in 2010.
So you were in the heart of corporate America. When I look at the companies, great companies you work for, what made you want to start a business by yourself? Startups is a long way from some of those company walls.
Yes, well, I had a thesis, my career thesis, to actually build a fintech firm, having been good at both finance and software. I like to break the mold, push the boundaries, and having worked at big organizations like Bank of America and Citigroup, as big as they get of a financial institution can be, there were things in there which do not encourage innovation. It is hard to get innovation through those walls, and we knew I will always have enough money to live for the life you have. Do something good with it besides earning money.
That's great. So talk to us a little bit about the product. What are some of the features that really stand out when people see or hear about it for the first time that they say, wow, how did we ever do without this?
Anybody who's seen the demo of our platform today, they see right in front of them what the client is doing and how our AI engine can get them $20, $30, $40, $50,000 more of after-tax safe retirement income. That's the wow factor. They have never seen anything like, there is nothing like that in the industry today. It's all the approach of a tool or a calculator where you change the levels left or right to see what is best. But going to an AI engine and saying, here's my client situation, and the engine tells you back, this is what your client should do. Advice, not a calculator that you play around with, but legal investment advice under the SEC registered investment advisors from us. This is what your client should do. They have never expected. And I would say from a recent demo we did with another institution with like almost 10,000 advisors, the gentleman, a senior executive from there, was shocked that client could get $2.5 million more in total through their retirement. And while doing so, Ada found a strategy which had $700,000 less in taxes.
Wow.
From the same amount of money the client had. That's non-intuitive.
So just to be clear, your tool is the target client for your tool is not the end consumer, it's the advisor. You're going to make an advisor smarter. Is that correct?
We have digital consumer-facing tools too, but our business model is to use them with institutions who have a distribution, who are licensed to work with these individuals, enable the digital tools for self-serve, supported by a phone-based retirement consultant or another phone-based professional for the mass market, and full professional engagement once you are over $2.5 million per se. So we got tools all over the place, but our business model is to work with institutions. So it's B2B and what we call as B2B2C.
Yeah, we mentioned this just before the show. I had an interesting lunch with a friend of mine from college, Laura, who also is in this space. Doesn't work with a lot of banking. And Manish, we had a fascinating discussion in a diner in Norwalk, Connecticut about the future of financial tools and companies that started, companies that fail is not the right word, but they've changed their the direction they've gone. One of the companies we talked about was a company called Financial Engines. I think it's actually merged with Edelman Financial Engines at this point. But I remember that as one of the first very sophisticated engines that was, I believe, marketed directly to consumers at the beginning. This must have been early 2000s. What lessons have you learned from other companies like that, trying to deliver complex tools to consumers to help them make long-term planning decisions?
So there are actually two different questions, right? So first is a startup like Financial Engine, kind of what happened in their direct-to-consumer experience. And then a bigger established institution, what they have done in that regard. So Financial Engine kind of showed the problem which is there even with today's robo-advisors was the acquisition, right? The cost of client acquisition, as you know, in the industry that you are in. Client acquisition is really, really tough to crack in the financial advice space. It's not so tough if you're trading or if you're even selling kind of, let's say, a property and casualty insurance, etc., and all of that. Just the advice where you want to hand over your money to somebody to steward and make an investment decision. In that, trust is a huge factor. And for an upstart, it is difficult to build the trust of a conventional brand. So that's for, at least for an upstart. From going back to the same question with respect to established institutions who are using a digital advice. If you look at any of the established institutions who've done true digital advice today, the second largest robo-advisor, I would say, is true digital advice. There is no human involved. I don't want to get into naming firms. I don't know if you can name them on here or not. But even that giant of an institution with millions of clients possibly only has around 25, 30 billion, maybe around maybe $40 billion or so of assets. And so it is hard even for them with their existing clients who just moved over money from a brokerage to this, despite having a good digital experience. I think there is just the nature of advice and the money and what are you going to do with it, and you're going to handing it over to somebody to decide what to do with it. Just that there is a lot of inertia in that change, a lot of inertia in that, compared to making a small purchase or even buying an auto insurance or a home insurance. It is much different from handing over money to somebody to invest.
You mentioned a few times the word trust, right? So the forum that we had mentioned earlier, the Reimagining Retirement, where you were a panelist, it was all about getting seniors to know, like, and trust in a virtual world. I noticed on Income Discovery's website, talk about self-service education and empowerment. What is it that you're doing to help empower people to build that trust so they're willing to make that connection? Obviously, with the understanding that if they're working already with an advisor, there's a relationship there. But for a well-rounded, how have you seen trust really be built well in a virtual world?
So in the virtual world, in the digital experience that Paul has seen briefly, and he will show more, is to be transparent with the outcome of the decision that you're recommending. So let's think of a client, right, and a retiree. We've got 3 levels to pull: when to claim Social Security, how much money to allocate to annuities for lifetime income, and how to invest the remaining balance in a different kind of allocation model. Now, if we are transparent to them that you can change these, here is the best recommendation we are making for you, which will maximize your safe retirement income, and let them play with those levers right online, that if they deviate from it down left or right, why that safe retirement income number comes down. So once you're transparent to them, and simplicity of the product is another aspect of it, right? The transparency comes with stuff that you can understand. We know a lot of products, especially on the annuities, are quite sophisticated enough. And if people are not able to comprehend it, you're not going to get the trust factor that built. So simple products, and let people transparently see the impact of the product on their retirement income is the best way to build the trust.
And I guess when I think of AI models and building a model, it's usually use a set of data with a person or some type of interaction that is repeated multiple times. If the fourth person on this guest were your model for building safe income and retirement, describe us what's the philosophy of the advisor behind the advice engine? Positive on annuities, negative on annuities, conservative with cash, aggressive on equities. Can you describe like how would this engine describe its view of the world of the future?
For an advisor with different propensity of using different products and has a different positioning with respect to the market. So this is what we call, as I say, a constrained optimization, or rather some form of view of the advisor and the institution with respect to what type of annuity products and how much of money can be allocated to annuities. What will compliance sign off on? They will not sign off on putting 60 or 70% of the client's money into annuities. So what are those upper limits? So you define those boundaries, and you also put your own boundary on, let's say, different asset allocation model and the return expectation on them. And you can also put your own expectation on the tax scenarios if you wanted to, saying that given the new administration, we expect taxes to be like this, not what they are. We expect the tax cuts to be rescinded or continue, whichever way, right? Once you put that, the AI engine can find the best solution against those expectations. That's the beauty of it, right? So it's not one same solution for everybody. Client situation will change, but institution advisor will shape what advice they are giving, customized by the institution, personalized to the retiree.
So interesting and timely. Now that we have a new administration, does your engine recommendations change, based on your company's view of impending legislative changes, or is that something you actually leave to the advisor and to their client?
So advisor and the institution put their view on legislative changes. So the example of tax cuts, which are passed by the last presidential administration, we have different institutional clients that have taken an opposing view. Some of them are saying the tax cuts will be expired. That's the way we're going to model it. Others say that we assume the tax cut will stay. And that is a prudent way. Kind of what it is right now, we'll just assume will continue. So institutions have different views, and we support both.
Interesting. So multiple companies use your engine. Same client may receive different recommendations based on views of both the advisor as well as their institution.
Yeah, and even their capital market return expectations, as well as their annuity product offering, because it is customized to what they have on the shelf and what kind of guarantees they offer.
Interesting. So if we fast forwarded 5 years to the retirement advice market, what does it look like? What does a typical advisor practice look like, and what kind of tools do they have in their arsenal?
So I believe from what we know at this point, and we know almost all of the competitors, there is not another, we call ourselves a platform, not a tool. There are multiple tools that play into it. The difference between a platform and a tool is that you're actually housing a particular client through a lot of steps into the retirement and every year, etc. And we know about them, and we're going to make adjustments to their income and recommend a lot of things to them and ongoing guidance, etc. So for retirement decumulation, there is a new business process that's required, which is going to be an extension of the wealth accumulation process and wealth management process that exists, which is focused on accumulation. We are actually defining that process and launching it with new institutions. That process doesn't exist today. And that depending on the different players in the market, an annuity distributor might just make the sale of the annuity and move on and not help people during retirement. The ongoing part, there are advisors who do that. So what I expect, and where we are taking the industry, actually, we are leading the charge with a couple of institutions who are thought leaders, is to define that process, entire process on creating the disbursals, all the client communications during retirement every year for annual disbursal, defining a process for if client wants a little more money than they planned for a car that they need to change right now. And If those kind of things can be accommodated, how do we guide the client on when to make adjustments to their safe retirement income? Should they reduce it? We plan with a high degree of safety. But when is the risk real that they should adjust? There is no method in the industry today which is standard. There just is no method at all. There's no business process defined around it. Advisors have been making decision on the whim by the seat of the pants, and we are trying to institutionalize that. And that's what we expect in the next 5 years will be. So we will be, with existing clients, we'll be serving about 1 million retirees with our existing clients in 5 years. And with a few more institutions we go, we might get to almost 8 to 10 million retirees. So we'll be pretty much defining the way it should be done.
That's impressive. One of the other stats that I saw on the website that stood out to me, and a little bit comes back to thinking about people and how they learn, how they interpret information. Obviously, this is a selection of very important decisions that will have a financial impact. So people need to see it, hear it, listen to it. And I saw a statistic on the website that talked about the power of the presentation to help drive acceptance rates. Talk a little bit about that, because at the 254% increase in acceptance rate, it's something I think we need to cover.
Yes, and thank you for bringing that up, right? And that's been a lot of work. So ADA is a powerful analytics, but we got to talk the story to the client in a way that they will understand, and we have to use all the principles of behavioral finance and psychology in doing so. So in fact, I didn't cover, and I've been running this about 11 years, and we've taken the approach of kind of bootstrap, and we brought it to a great point. And I spent the initial 5, 6, 7 years all on analytics, and after that, it's all been on psychology and presentation. And in driving, so I will take that number of 254% is real from one of our largest institutional clients. And how that has happened, I'll give you some baseline numbers for them, right? They were at a point where, despite people contributing to their annuities in pre-retirement for many years, on retirement would not annuitize that into a live stream of income. They would use the annuities as a liquid investment portfolio, get the fixed return or the variable return, and kind of do a systematic withdrawal from it. And then the baseline number that they had, where people were actually annuitizing, was 11% of the total people who retired. We were able to lift that in a couple of years to 39%. And that's where the 254%. These are real numbers, and we have not stopped there. We are waiting for the last year's numbers. We believe we're going to be inching past that number. And I believe we can take it to 65, 70, 80, even higher. And we're working on a lot of those things right now with the latest iteration of presentation. So it comes down to many, many things, as you see, compared to the rest of the industry and all the financial planning tools. We do not use the word probability of success in our presentation. That's for the actuaries, not for the client. We call shortfall risk. We don't present numbers in percentages. We present them in frequency. A probability of success of 90% is not psychologically equal to probability of failure of 10%, which is psychologically not equal to shortfall risk of 10%, which is not equal to shortfall risk of 100 out of 1,000. All these four presentations, economically the same thing, have very different behavioral impact and interpretation. And that all goes to extensive behavioral finance research. So we talk about shortfall risk. People want to know, you know what, if you talk about shortfall risk, how much will be my shortfall? So we've thought carefully, what is your total shortfall in the near worst case? We present you those dollars. We, again, don't present it as a percentage of your income. There's a lot of thinking that's gone into it. We present your legacy or bequest. People want to know, will I be able to leave behind anything? So there's a huge amount of work that's gone into it. Right now, we have added a very pertinent part. How much of your Social Security are we able to get you tax-free? If you don't follow ADA's advice, which if you follow ADA's advice, you can have $1 million of Social Security completely free of taxes. People care about this, right? It's about telling that story in the simplest way to aid in a decision-making. So you're always focused on decision-making. You see 3 plans in the report. Not 1, not 2, not 5. 3 is a magical number. There's a lot of behavioral psychological research that 3 is the best way you get to a decision. How do you arrange those 3 options? What's the first? What's the second? What's the third? it matters. And so there's this huge amount. I told you, like, half my time in the firm was building the analytics, half the time has been telling the story.
Interesting. So success is not the solution, it's actually driving the action. Manish, is that a fair way of how you define success?
So success in terms of the analysis and the presentation.
And with the customer, with the end customer who's been working with the advisor.
Yeah, so we don't want to use the word success or failure when you're talking about, because when you talk about success, you're talking about the antonym of that, which is failure. And when you're talking about somebody's retirement, why do you want to talk about a binary of success or failure? Somebody's worked his life, saved the money, is going into retirement, and you're saying, there's a 10% chance you will fail. What the heck? What's failure in retirement? There is no failure. So why bring success or failure? And why probability? I mean, who are we talking to, right? I mean, probability is a statistical term. A lot of people have not taken the probability course in the high school. We have to talk in simple terms. I mean, there are 1,000 hypothetical retirees. Out of that, 100 of them have a shortfall. That's what matters. There'll be a shortfall. It's not a failure. So the words matter.
Language does matter.
Words matter a lot, right? We know even in the presidential election, the previous one, this one, words matter. Every word spoken can have a dramatic impact.
I noticed that. I mean, even the use of full and rich retirement. It speaks differently, or it resonates differently than some of the other words used within different product conversations. So I found that interesting, and I'm sure there's an entire selection psychology behind those two words. But I guess in one or two sentences, what does retirement mean to you? Because that was another thing that we had a full discussion on: is what does retirement look like? What is retirement age? What are retirees? But to you, what is retirement?
You mean me personally, or
personally? Yes. Based on all of your research and development of these products, et cetera?
So from me personally in the retirement, I think it's going to be a little bit similar to some of the mentors and investors that I have in my firm, right? Where you have a wealth of knowledge and experience, and you pass that down, right? Acting as a coach, as it's called, or with the Indian word guru, right? Act as a guru for others to pass the knowledge down.
That's great. Well,
that's good. Well, I guess let me ask you, since you've really been sort of on both sides of the fence, the corporate and the startups, what piece of advice would you give? Well, first, let's start with other startups who may be headed down the same path you are. They see a large problem, and but they may be 3 or 4 years behind where you are today.
So my advice to them, so basically the startup, the one thing that I read through a lot of books before I started off was it's going to be hard. It's going to be very, very hard. So you need a lot of persistence, but you got to work at it, and you got to have a lot of thick skin and keep on moving along and keep on chugging along. That's the ultimate truth. In startup, it is not romantic. It is a very, very tough place to be in.
So if people are interested in learning more about the product, about income discovery, if they have questions, if they want to learn about the psychology behind it all, what's the best way for them to get in contact with you?
They can reach me, Manish, at incomediscovery.com, or our sales email, sales@incomediscovery.com. Either one is fine. We'll work on our side to reach out to those institutions.
All right. Manish, listen, thanks so much for your time. Laura, good to continue our discussion, and make sure to tune in next week for another episode of the Reimagine podcast. We want to especially thank today's sponsors, Launch and Symetra.
Thanks for listening. If you enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more great information about this company and other great startups at imagine.nsre.com.